What does it truly mean to be well-informed about a company's financial health? And maybe even more important, its future path. It's definitely more than just, skimming a press release, isn't it?
Yeah.
So today we're doing a deep dive into Blue Jet Healthcare Limited. Our plan is to really get into Blue Jet Healthcare's Q1 FY26 results. We've gathered everything we could find, the official press releases, their investor presentations, and we even listened to the earnings call audio to get the flavor right from management.
Right. And our mission here is simple. Cut through the jargon, get to what really matters. We're not just reading out numbers. We want to understand the strategy, the why behind those figures. Basically, this deep dive is meant to give you a shortcut, a really solid understanding of what's driving Blue Jet.
Okay, sounds good.
Yeah.
Let's unpack these Q1 FY26 results then. Blue Jet, well, they started the fiscal year with some pretty significant year-over-year growth. It really jumps out at you. Their revenue from operations hit Rs, 3,548 million. That's a huge jump, like 117.8% compared to Q1 last year, which was Rs, 1,629 million.
More than doubled, yeah.
Exactly. And profitability looks strong too year over year. EBITDA, that's earnings before interest, taxes, depreciation, and amortization, climbed to Rs 12,210 million. That's up 173.3%.
Impressive.
And their profit after tax, PIT, that reached Rs 912 million. So growing 141.3% compared to last year. Even earnings per share, EPS, profit per share basically, went up quite a bit to Rs 5.26 from Rs 2.18.
Yeah, that year-over-year story is definitely compelling, no doubt about it. But it's always crucial to look at the sequential picture too, right? Quarter over quarter, and that's where things look a little different. Revenue, okay, it was up slightly, about 4.2% from Q4 of last fiscal year.
Okay, still up.
Still up, yes, but EBITDA actually dipped 13.6% compared to the previous quarter, and PAT, profit after tax, that also saw a degrowth, down 17.2% quarter on quarter. So naturally, their margins took a hit sequentially. The EBITDA margin fell 701 basis points, so 7.01 percentage points down to 34.1%, and the PAT margin dropped 664 basis points to 25.7%.
Okay, that is interesting. Revenue still growing sequentially, but profitability dips. That's a bit of a head-scratcher, isn't it?
Oh.
What was the reason for that, especially with those strong year-over-year numbers as a backdrop?
Well, management gave a pretty clear explanation on the call. The main driver, they said, was a drop in their gross margin. It went from 54.7% in Q4 down to 48.4% in this quarter, Q1 FY26.
Okay, why the drop in gross margin?
Two main things. One was a shift in their product mix, which can happen quarter to quarter, but the bigger factor was a reduction in their inventory levels.
Inventory levels, how does that affect margins?
Right, so it's about something called overhead absorption. When a company builds up inventory finished goods, work in progress, some of the fixed manufacturing costs, the overheads, get allocated to that inventory value on the balance sheet. They don't hit the P&L immediately.
Got it.
But when inventory decreases, like it did significantly in Q1, those previously capitalized overheads associated with the sold inventory get released and recognized on the P&L all at once. So it compresses the reported margin for that specific period, even if underlying sales are okay.
Makes sense.
The CFO specifically pointed out our $750 million drawdown in finished goods and work in progress inventory in Q1. Compare that to Q4, where they actually had a Rs 100 million inventory buildup. So a big swing.
Oh, okay.
They called this an aberration for the quarter. They actually said if you look at Q4 and Q1 combined, the cumulative gross margin smooths out to around 53%, which sounds more, typical for them. There were also a couple of minor things, a one-off Rs, 27 million GST demand, and slightly lower Forex gains, but the inventory impact was the main story for the sequential margin dip.
Right. That really shows how you need to look beneath the surface, doesn't it? A headline number might hide these operational details. So for you listening, this is a key takeaway. Those high-level figures don't always tell the full story. An inventory drawdown like this might hit margins temporarily, but it could also mean they're managing stock well or seeing strong demand pull through, not necessarily a red flag. So we understand the number nuances now, but you mentioned product mix. Where did the growth actually come from? Management highlighted specific areas, right?
Absolutely. Let's break down the segments, focusing on that strong year-over-year growth. First, Pharma Intermediates and API, PI and API. This segment saw just, exceptional growth. Rs 2,120 million in Q1. That's a massive 356.4% increase year-over-year. Yeah. Management talked about really strong momentum there, especially cardiovascular intermediates scaling up nicely under long-term contracts. They see good demand visibility and expect more launches in the second half of the year. Then you've got contrast media intermediates, or CMI, this is what they call their flagship vertical. It grew to Rs 972 million, which is up 50.7% year over year.
Still very solid growth.
Very solid. They mentioned volumes from new molecules launched late last year have now stabilized, and they expect sequential growth to pick up again in the second half as clients ramp up their orders. And this CMI segment is critical, you know. They supply key inputs to the big global names, GE Healthcare, Gerbet, Bracco. Some of these relationships go back decades, like 26 years in one case.
That's stability.
It is. And management pointed out that the market for the final contrast media products is expected to grow significantly, maybe from $6.7 billion to $10 billion soon. So customers are pushing them for more capacity.
Okay, makes sense. What was the third segment?
Right, the high-intensity sweeteners, or HS. That reached Rs 349 million. Also a big jump year over year, up 251.9%. Volumes were steady, and importantly, the average selling prices seem to be stabilizing after what they called a soft FY25. Their strategy for value-added sweeteners is still on track. They supply hundreds of customers globally, including names like Colgate-Palmolive here in India and Unilever.
So across the board, strong performance in the key segments year over year. But it sounds like there's more to it than just selling products. You mentioned this collaboration, development, manufacturing model, the CDMO approach, especially in pharma.
Exactly. That CDMO model is where their strategy really shines, and it taps into some major global trends. First, you've just got this general move by big pharma companies to outsource more manufacturing of intermediates and APIs. It lets them focus on R&D, be more asset-light.
Focus on their core.
Precisely. Second, and this is a big one, there's a huge push globally to de-risk supply chains, especially reducing reliance on China. Things like COVID and rising costs in China have really accelerated that trend.
We hear a lot about that.
Yeah. Third, you have government initiatives like the PLI schemes here in India, encouraging local manufacturing and import substitution. And fourth, just the overall growth in the global pharma market itself. Blue Jet plays smartly in this space. They focus on high-value intermediates and APIs, often for chronic conditions like cardiovascular, oncology, CNS. And critically, they often work directly with the innovator companies, the ones developing the original drugs.
So not just competing on cost.
Not primarily, no. For these innovator clients, reliability, quality, and technical expertise are often more important than just the lowest price. That's Blue Jet's niche, specialized, high-quality solutions.
Okay, so they're clearly riding some important waves. But what about building for the future? What are they actually doing to sustain this? It sounds like they're investing heavily.
They are, and it's across capacity, R&D, and operations. Let's talk capacity expansion. Their Unit 2 in Ambernath, Phase 2, is now fully up and running for PI and CMI. Production is consistent, order book looks good. That cardiovascular intermediate, for instance, is running at about 60% capacity, so there's room to grow there.
Good utilization already.
Yes. Then there's Unit 3 in Mahad. Construction is on track, expected commissioning in the second half of FY26. This is really strategic. It's for backward integration in their CMI segment. They'll be making a critical starting material, a KSM, using flow synthesis technology. This gives them more control over their supply chain, less dependence on external suppliers, and should help insulate them from raw material price swings.
Smart move. Any changes there?
Well, the projected cost, the CapEx for Unit 3 has gone up a bit from Rs 250 crore to Rs 300 crore. They've spent about Rs 100 crore already.
Okay.
And looking further out, they've basically quadrupled their total manufacturing capacity in just the last 4 years. The plan is to add another 1,000 kiloliters over the next 2 to 3 years. They're even acquiring a large piece of land for a completely new world-class CDMO facility. Phase 1 is planned to have 4 blocks, 2 for contrast media, 1 for a new type of high-intensity sweetener, and 1 multi-purpose block, probably for other pharma intermediates or APIs.
So a serious commitment to future capacity. What about innovation, R&D?
Big focus there, too. They're putting Rs 40 crore into a new R&D center in Hyderabad. The focus is on newer chemistry platforms, things like peptide intermediates, think GLP-1s, those drugs for diabetes and weight loss that are booming, and also biocatalysts.
Peptides are definitely a hot area.
Absolutely. They said they're currently tracking about 20 new opportunities coming through their pipeline. And importantly, about 6 of those, so roughly 30%, are already in late phase 3 trials or actually commercialized. They've also done specific work developing amino acid derivatives and 45 different peptide fragments. But they emphasize this isn't just building a catalog, it's based on strong interest and conviction from specific clients.
Targeted R&D then.
Exactly. And operationally, they mention costs like employee expenses and utilities are well controlled, and they're optimizing their cost of goods sold. Oh, and sustainability, ESG. They reported that 70% of their energy now comes from wind and solar. They seem quite committed to things like carbon sequestration, reducing solvent use, recycling, and proper effluent treatment.
Right. So putting it all together, what does this really signal for you, the listener? It paints a picture, doesn't it? This isn't a company just reacting. They're actively investing strategic capacity, very specific R&D in emerging areas, sustainable practices. It really looks like they're positioning themselves very deliberately for future growth, anticipating that global demand, especially from innovators wanting reliable, diversified supply chains. So we've really dug into Blue Jet Healthcare's Q1 FY26. We saw that impressive year-over-year growth, unpacked the quarter-over-quarter margin nuances, and looked at the strategic drivers, the segment performance, the CDMO model, and these really significant investments in expansion in R&D.
Yeah, and if you connect the dots, it really highlights how these specialized companies like Blue Jet are cleverly tapping into these big global shifts happening in pharma manufacturing and supply chains. It's a great example, I think, of how deep expertise in a niche, when you combine it with smart strategic investment, can create really significant value and impact.
Definitely. So for you, the listener, maybe something to think about. How will this ongoing push for diversified supply chains, for more outsourcing, continue to shape things for specialty intermediate companies like Blue Jet? And what kind of new breakthroughs might we see coming out of focused R&D in these cutting-edge areas like peptide fragments? We've given you the core analysis from the results in the call. Now, the real deep dive continues as you keep connecting those dots.